The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A big day for big tech as the NASDAQ tumbles toward correction. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick, and you cannot make me laugh at the start of the show like that.
I didn't. You made me laugh. Okay, I spilled a big drink on the set right before the show. That's what's happening. It kicks us off very well for earnings season, if this bodes well here. You got the S&P down by about 0.6%, right around the lows of the session, but we're also really looking towards earnings. We've got tech getting hit quite hard as well. Now, let's take a look at some other asset classes here because they may be moving on different things. So crude getting hit yet again near a 7-month low. Those China worries through earnings or through GDP reads like over in Germany continue to filter through the market. 2-year yield, though, getting a bid as geopolitical risk over in Israel and Lebanon continues to heat up as well as dollar yen. The yen getting a little bit of outperformance here as the BOJ is just hours away now, Romaine. Will they finally hike those rates?
Yeah, absolutely. That is a big question of the day, but the big question of the moment right now revolves around big tech, with the NASDAQ 100 sell-off entering new depths, now down 9% from its record high back on July 10th, the precipice of correction territory. It flirted with it earlier in the session, and whether that index actually tips over the edge, likely to be determined over the next 72 hours. Microsoft earnings tonight, a big Fed meeting on Wednesday, Apple and Amazon reporting on Thursday. Now, we should point out that traders have really become increasingly concerned that tech companies aren't yet seeing returns from all those big investments they've been making in artificial intelligence. Alphabet's sell-off last week indicative of that, really raising the bar for Microsoft, which for a stock trading at 32 times projected profits needs to show that its AI-related spending growth is translating into sales growth as well. Kate Moore at BlackRock, cautious, but still seeing opportunity.
We've been cutting tech a little bit since the kind of the peak we had in the mid-late spring, but we still feel convicted that this is going to be the most powerful theme over the next couple years.
A conversation there about tech, a conversation up ahead also about the airline sector. JetBlue beating Wall Street expectations in its latest earnings report. Budget carrier Spirit considering ways to go premium, and plane maker Airbus trying to solve its supply chain issues. A conversation ahead with Guillaume Fauey, the CEO of Airbus. But let's circle back, Alex, to the big story of the day, certainly once we get to those closing bells, and that is Microsoft and big tech.
That is Microsoft. Let's get to the highlight here, which is what you were just talking about in terms of CapEx. This is a great chart showing the quarterly CapEx of Microsoft. And here we have it for the first quarter coming in at around $11 billion. Now, the estimates for this quarter could be as much as $13.3 billion. Now, for some extent, investors were happy to see that CapEx because the more you invest, the more the monetization and the return you'll get on that investment. Now their questions are you spending too much and not being able to monetize those AI offerings at the same time? And that gap and how long that gap lasts, now really the question, Romaine, because no one wants to be the first hyperscaler to now spend less on AI.
Absolutely. And that is the question that we do want to pose to our guests today, including Michael Turrin, who's joining us to kick us off to the close here on this Tuesday afternoon. He's managing director and software analyst over at Wells Fargo. Microsoft coming out tonight. You know, Michael, everyone's going to be focused really on Azure and really on AI. What's most important to you later tonight?
Yeah, look, if you're spilling drinks, you're as nervous as tech investors starting the soft earnings cycle here. Definitely all focus on Azure and AI as a starting point. I think Microsoft surprised to the upside, guiding for 28%. Attribution at least ticks up a bit from the 700 basis points we saw last quarter. The good news for Microsoft is they are one of the only companies in software that is quantifying AI contribution, and I think that was intentional, just given the uptick in CapEx that we're seeing. But obviously, you're right. The primary focus is Azure and AI, followed up by margins and CapEx and Office Copilot, if I had to put a third in there.
Well, let's talk about the CapEx side, because this seems to be where we're seeing a lot of the hand-wringing, if not by analysts, certainly by the media, our present company included. And I do wonder if maybe we're making too much of that, because there is this discussion, in all seriousness, Michael, the idea here that the CapEx is high, but at least for companies like the Microsofts and Apples, we're talking about just cash cows here. They have the cash to burn if they want to burn it. Are investors going to be comfortable with that if that cash burn continues?
Yeah, I mean, we've said AI exuberance is leading to AI impatience now, and I can certainly understand why. But you're right, for Microsoft, this is a $2 trillion company. Certainly the amount of CapEx being thrown into this is non-trivial, but they also have Azure. So I think Microsoft has the benefit of some diversification where they can spin up data center capacity and basically turn it where the market is heading. Right now, Microsoft has a lead in AI. This is the first tech lead Microsoft has had in a major tech shift in quite some time. Recall Azure was a fast follower alongside AWS. So Microsoft has no intentions of slowing down here as far as we can tell. And I would agree that even though our number for CapEx for fiscal 25 is $67 billion, and every investor we speak with says that's too low, likely not much slowing down. And the benefit for Microsoft is Azure demand remains quite robust. And so building data center capacity is something that's just well aligned with the broader cloud aspirations of the company.
Michael, then to dumb it down for me, if we wind up seeing a sell-off on higher CapEx spend like we did with Google, for example, is that a buy the dip for you then?
It is. The parallel I draw, and again, it's a software-centric lens, is what happened with cloud. So when cloud started and Amazon broke out their financials with AWS, every software investor said, oh my gosh, what is that? And then every software company in the infrastructure layer had a really hard time finding a multiple because the view was no companies on the infrastructure layer would exist. And that was a little short-sighted. And it took some time for the multi-cloud thesis to play out. But I think most investors agree that this generative AI shift is real. And the question is just how long will the shift take? I think most software companies we cover are saying we have to get the foundational technology right. So that's going to take some time, and it's more likely into 2025 where we start to see material contribution. But there's a lot of innovation and a lot of building coming. And I am still of the mindset as well that this is something that Microsoft is better suited to stay in front of, and investors should be willing to stay the course here also.
We just got word that the Microsoft Azure, I should say, sees services now fully mitigated by about 8:30. But that really puts it in a tough spot because this has been a really tough day for Microsoft when it's had all these issues with its 360 as well as the Azure cloud, and then you had the CrowdStrike issue a couple weeks ago. I mean, what do you think? What are your questions going to be on this on the Microsoft call?
Yeah, definitely tied to some of what we're talking about, the confidence in the durability of growth. The demand signals they're seeing in AI are quite important. One thing they put out last quarter was a suggestion that the AI contribution metric could have been even stronger, but they were somewhat supply constrained because everyone's fighting for GPU capacity. So understanding that supply-demand relationship on the AI side is quite important. Beyond that, we're focused on Copilot, both Security Copilot and Microsoft 365 Copilot have the potential to become meaningful product cycles alongside all of the other innovative product categories that Microsoft is focused on. So those alongside security, right? There are questions we're getting around, is the incident that happened a few weeks ago something that Microsoft could actually lean into and create the case for leveraging more Microsoft first-party security solutions instead of third-party solutions, because it seems like it's more the upgrade cycle, the maintenance that's tied to maintaining multiple systems that was at fault here, not Microsoft specific.
All right, Michael, going to have to leave it there. Always great to catch up with you. A busy day, or actually a busy few days ahead for you. Michael Turrin, Managing Director and Software Analyst at Wells Fargo. A closer look at Microsoft coming up after the bell. In between that right here on the show, a conversation with the CEO of Airbus. Going to be joining the big program with his outlook on the pace of manufacturing as aircraft demand continues to take off.
Plus, shares of Novavax plunging as JPMorgan delivers a downgrade and a street low price target on the stock. We're going to dig into the call that's rocking the stock.
And down in Washington, the Fed beginning its two-day meeting, and a lot of investors reversing their stance on when rate cuts just might happen. Goldman CEO David Solomon reportedly now seeing up to 2 rate cuts in 2024. We break down all the market expectations ahead of Decision Day tomorrow. All that and more coming up in a bit right here on The Close on Bloomberg.
Airbus reporting earnings today, beating estimates with U.S. ADRs up almost 4%. Its commercial and helicopter divisions drove that beat despite higher costs in its space unit, which racked up almost $1 billion in charges in the first half. Joining us now for more on this is Guillaume Fauey, CEO of Airbus. Guillaume, thank you so much. I know it's quite late where you are, so thank you for joining us. I just want to start on the space issue and get to that root cause. You mentioned one entrant in the marketplace really messed things up. Can you give me more color onto what that is?
So we have programs which are under long-term estimate at completions. And we have underestimated the risk that we have embarked when we signed the contract or when we launched the programs. So we have had to record charges in our space program earlier this year. Actually, we informed the market in June of our challenges, and that's where we are in space. So we have launched a turnaround of the programs. We are focusing on those programs, but also turning around the business itself. So that's an important activity for me this year and for my team to focus on the recovery of space and against the backdrop of a challenging business environment in space.
So no color into what that new entrant is there?
Exactly.
Okay. Just one more point on this. As you look at the different options for that part of the business, how long do you think that's going to take until you find the right solution?
As I said, it's several programs. Some of them will be fixed in the couple of months or quarters to come. One of those programs is a longer one, is over almost a decade, implicating investment in development, industrialization, production, and then deliveries of satellites. And this will take by far more time to be fixed. We will have a better understanding of the level of charges and the impairment that we need to take on this particular program by the end of this year.
All right, Guillaume, I do want to talk about the commercial side of this business. You have issues over there, though I think issues that any of your competitors would love, and that's a lot of demand, but you're still dealing with a lot of supply chain issues that is limiting what you can actually deliver. When do you think those supply chain issues will be sorted out?
Actually, we are in a phase of steep ramp-up. As you rightly said, we have a lot of demand. Actually, we have a backlog of roughly 8,500 planes, and there is a lot of demand for short-term deliveries. So we're trying to find the right speed of ramp-up that is a compromise between a very strong demand and contractual obligations that we have taken and the ability of the supply chain to deliver on that ramp-up. And unfortunately, we have to adapt to the weaker link of the chain, to the slower ones, and it's not always the same. In 2022, we had plenty of difficulties with small and mid-sized suppliers, plenty of different reasons. That's behind us now. We had a successful 2023. And this year, unfortunately, we're hit by suppliers that are delivering systems that arrive late in the final assembly line. So we have limited ability to react to their own difficulties. So we are now focused on fixing those issues before we can continue to ramp up efficiently, hopefully for 25 and 26. So that's a bit of a case-by-case situation to be managed.
With regards to those suppliers that are either coming in late or just not meeting the obligations in some way or another, are you getting cost or price concessions as a part of that?
We have contractual arrangements with them. When they don't deliver on time, they're obviously under the risk of liquidated damages. Now, we are also open to finding other ways of dealing with the situation when that makes sense for us. But indeed, they are penalized when they are not able to deliver on time and when they lead to us being not able to deliver to our airline customers that really need the planes. So that's the situation we're in. We prefer to get parts on time than being compensated, obviously. But when it is the case, that's what it is.
Guillaume, what is your level of confidence that you can monitor all the supply chain in real time and that there won't be more surprises like the LEAP engine that come down?
It's a big challenge. We can't be monitoring 100% of the supply chain with the same degree of depth and of energy, of focus of teams. So we have organized during COVID what we call watchtowers, where we are reviewing, where we're scanning, where we're assessing all of our suppliers based on risk. We determine the ones that are the most likely to cause issues and problems, the weaker ones, and then we're focusing our efforts on those ones. Now, when it's about engine makers, for instance, that are late at the moment, they have themselves a very deep supply chain, they are very structured, and they are in a complex business, so we cannot do the business of engine makers as we are aircraft OEM, but we're trying to alleviate the consequences, to mitigate the consequences of their own difficulties, but we can't be monitoring the whole supply chain ourselves.
Let's go to the defense side of the business for a moment and talk about supply and demand there, because it feels like the path of least resistance is going to be more European spending on defense, no matter who wins the White House in the United States in November. Can you take more orders for your defense areas right now?
Yes, we can. Indeed, Europe is in a different situation since February 2022 with the attack of Russia on Ukraine. That's a very different environment when it comes to security, when it comes to defense. And indeed, the European countries, most of the European countries have decided to spend more money for security and defense, and we can take more orders. Actually, we have seen an increase of the order intake in 2023 compared to previous years, and we have a good start in the year 2024. So that's a different situation than compared to commercial. We have available slots and capacity, and we can take more orders indeed.
Do you think, Guillaume, you're going to see more business on the defense side, that is, from non-European nations?
We have a good flow of business from export countries. That's very important for Airbus. We are mainly living from export orders and contracts. It's the case as well in defense. Now we have up and downs from one year to the other one. And I would see the main area of growth for defense business coming from European countries more than from the rest of the world. But there will be also some good export contracts here and there. So that's basically the situation. Rather stable on export and significant growth for our home countries.
How much discussion have you had with world leaders, or at least their representatives of these world leaders, who of course are contending with the issue of how to deal with some of these military contracts and at the same time keep some of that sensitive information that goes into that sensitive technology away from their would-be adversaries or their perceived adversaries? What are those discussions like?
Yeah, we have a constant dialogue with our governmental customers, the European countries, but as well countries outside of Europe, on how to do business, what kind of information can be exchanged, the confidentiality of activities. And we are also under the regime of export licenses that are very important in our industry. We can only export with the approval of the countries from where we are exporting, and that's very much related to the nature of the relationship they have with the countries we want to export to. So that's a complex construct. It's not unique to Airbus. We are working under the same regime, but those days with the quite tense geopolitical situation around the world, that's something that is taking more time, more effort, and that has gained in terms of importance.
Guillaume, before we let you go, when we keep hearing from airlines in their earnings, it's all about capacity. They got to take out capacity. They have to take out capacity. At some point, do they go to you and say, hey, just kidding, we don't need those planes because I have to take out capacity?
Our airline customers are facing strong demand themselves. So indeed, they want planes. They want planes as much as we can deliver, but we are limited by our supply chain issues and constraints. It's not specific to Airbus, as you know. So we are working hand in hand to trying to find the best way to satisfy their needs. And then there's no general statement. It's a case-by-case discussion depending on the priorities, the ability to deliver, and the particular situation that comes with this airline or that airline in the US, in Europe, in Asia. Each and every situation is different.
Hey, Guillaume, you only have about 30 seconds, but I do want to just get your thoughts on the interest rate environment. We've got a big Fed meeting here in the United States, and there's been a lot of speculation about whether other global central banks will start to cut rates in a meaningful way this year. Does that affect you, or at least affect your outlook?
It has an impact. It's a moderate impact for us, but we've been in a rather complex environment in terms of inflation, in terms of interest rates, and that makes the life of companies more difficult. We need to be able to anticipate. We need certainty and visibility, but having the rates going down is going to be a positive news for us, and obviously this is something we are monitoring.
All right, Guillaume, really appreciate you taking time for us. Guillaume Fauey there, he's the Airbus CEO, right on the heels of the plane makers' big earnings. And actually, the earnings were actually pretty good. I mean, obviously, a lot of concern here about whatever's going on with that space business here. And even on the commercial side, they've got issues. But again, this is more of a problem of having too much demand and not enough of the supply to actually cater to it.
Is there like a tech thing that I can make for this? Like too much demand and not enough supply? I mean, that's something we're going to have to look at through with some of these tech guys when they come out. Like they can't book the revenue if they can't wind up selling the product because there's just not enough of it.
Yeah, absolutely. And it's kind of interesting, too. He talked about some of the suppliers. Obviously, he wouldn't name them, but he kind of made it clear that this is a lot on their end. And he kind of alluded to the fact that they do get some concessions here. So maybe financially, it all sorts out for them.
But it is really tricky because you can't see everything at once.
Yeah.
Like you can't have eyes on everything. So how do you have that kind of security in your supply chain?
Yeah, I don't know, but you have to, right? I mean, that's the challenge of being a plane maker CEO, as the other big plane maker CEO learned the hard way over at Boeing.
Very much the hard way. That's a good point.
Absolutely. All right, when we come back here, we're going to take a look at some of the big movers on the back of analyst recommendations, and that includes a firm cashing in after getting a new bull on the street. That's coming up next. This is The Close on Bloomberg. All right, time now for our top calls. These are the big movers on the back of analyst recommendations, and we start off today with a firm. Bank of America lifting its rating to buy from neutral. The analyst saying the buy now, pay later lender can reach profitability sooner than expected, and a potential drop in interest rates should help to lower the company's funding and transaction costs. Those shares rallying by about 2% here on the day. Next up, let's take a look at Sprouts Farmers Market. A positive earnings report yesterday, an analyst upgrade today. BMO Capital raising the market perform, saying same-store sales last quarter were too strong to ignore, coming solidly ahead of buy-side expectations despite competitive risk from more mainstream grocers. That stock having its best day in about 2 years, a 13% rally. That pushes a 15% rally, that pushes it to a record high. And finally, let's take a look at Frontier Group, getting its first sell rating since going public back in 2021. A cut to underweight over at JPMorgan. The analyst, Jamie Baker, growing increasingly uncomfortable with the budget airline's reliance on sale leasebacks. He says it's leading to capacity temptations in excess of what demand can potentially handle. Nevertheless, the shares rallying 4% on the day, and those, Alex, are some of our top calls.
All right, coming up, Federal Reserve rate decision out tomorrow. Our conversation with Phoebe White, head of U.S. inflation strategy at JPMorgan. This is Bloomberg.
Well, I think he's going to say that they are more confident that inflation is starting to move back towards their goal after progress had stalled in the first half of this year. Of course, the fact that shelter inflation has shown more progress in the last few inflation prints is going to help in that. But I don't think that they're going to, I don't think they're going to be in a huge rush. We think they are going to signal a September cut.
Tiffany Wilding, the chief economist over at PIMCO, talking about our expectations for a big decision day for the Fed tomorrow. Romaine Bostick here alongside Alex Heel, counting you down to the close, and I guess counting down to that Fed meeting as well, as investor expectations have really shifted over the last couple of months.
But then we get the numbers today from JOLTS, right? And that quit rate's coming down, but the number overall moved higher, and consumer confidence was okay. Like, it was mixed, but it was okay. So if growth is resilient, though, how do we extrapolate inflation from that?
That's the conundrum here, right? Because, I mean, you can look at all these data points and you can make a case for cutting. You could also look at those exact same data points and make a case for just keeping rates where they are.
Yep, confirmation bias. So let's get someone's take who may have a stronger opinion than Romaine and I. That's Phoebe White, head of U.S. inflation strategy over at JPMorgan. Phoebe, it's like a Rorschach test for Romaine and I when we're like parsing through the data and trying to figure out if it's good or bad or what the Fed should do. What do you think we're going to hear from Powell and how that outlines September?
Well, first of all, thank you so much for having me. So I think we will hear from Powell that the recent data is adding conviction that inflation is on the right path. And I think, the signaling will set up that first cut coming in September. That is our call. But I think it's going to be really interesting to hear how they are reading the data. I think you're right. A lot of the data recently has been mixed and is sending somewhat of a muddy signal here.
So could that mean that maybe we hear Powell give a more balanced view of what could happen versus setting up the stage for September? And if that happens, what happens to the market?
Well, I think the case is still there to start dialing back the level of restrictiveness in the policy rate. I think in terms of talking about the balance of risks, it's going to be interesting if they start to shift their focus away from inflation, right? I think the first half of the year, all that has mattered was the inflation data. I think what we're seeing now is that, and this is something Powell said in his testimony 2 weeks ago, inflation is not the only risk they face. So how are they reading the labor market data? The fact that the unemployment rate is now 0.7 above the cycle low. Is there something to be worried about there? So I think that's really what the focus will be on.
Give us a sense here, though, Phoebe, when we talk about the idea of how you sort of create the criteria for cutting. And we have a market that went from, of course, at the start of the year, anticipating 5, maybe even 6 cuts to basically no cuts. Now they're basically back to somewhere around 2 to 3 by the end of the year. There's a lot of talk here about the election cycle and how the Fed doesn't want to get in the middle of that. If they don't cut tomorrow and they don't cut in September, what other options do they have?
Well, I think they could still certainly go in November. I think that the election won't necessarily hold them back on that front. But I think, they're waiting longer to see, for a little bit more data. I think that's the case for waiting instead of going tomorrow, waiting until September. But the case is still there for them to, again, start dialing back that level of restrictiveness. I think we got a mixed signal. Early in the year, we came out of a few months of very weak inflation readings, and then clearly the upside surprises that we got in the first quarter on the inflation front. We're in a sort of weird macroeconomic backdrop right now where I think all of the data is just more volatile. And so you need to smooth through some of these ups and downs. I think when you do that with the inflation data of the last 9 months, still sending us a signal that inflation is probably somewhere, in the mid-2s. It's still above target. They're not all the way back there, but they're more comfortable that they've made progress on that front. And now it's time to maybe pay a little bit more attention to the other side of the dual mandate.
I am curious, Phoebe, there's a lot of talk right now about Fed rates, the Fed funds rate, a little bit less talk about the quantitative tightening, if you will. I have no idea if they're even still tightening or not because they don't talk about it much anymore. But you are seeing a pickup in volatility on the shorter end of some of the fixed income curves here. Is that a sign that investors are expecting more there?
So I think, they've been clear about talking about balance sheet policy as a normalization, right? You can think of that balance sheet policy on a separate track from rate policy. They're not really talking about the balance sheet policy as tightening. It's true that, yes, there's been more focus on that. We've seen, some movement in SOFR relative to Fed funds. We don't think that's a sign of reserve scarcity at this point. We think that liquidity in the system is still ample. So we think that QT will continue, through the end of the year. And that can still go on even as the Fed starts to, do some rate cuts, probably get in two cuts before the end of the year.
What kind of volatility, you mentioned that earlier, might we expect? I'm just looking at the 210 curve. We're at negative 21 basis points. How we get steeper has been quite up for debate. Barclays had a note out talking about the volatility if President Trump gets elected, particularly in the bond market. What should we brace for?
Yeah, so I think it's a really good point, and we haven't had a lot of conviction on duration right here. I think it's hard to feel comfortable extending duration when the market is already priced for so much easing, even through the end of next year. We've had more conviction on the shape of the yield curve. We think that the yield curve can continue to steepen into the end of the year, and I think that can take two forms. And on one end, if we're right and we see kind of gradual, slowing in growth, cooling in labor markets, and potentially even more weakening than we're forecasting, we could see the front end of the curve leading the way lower, especially sort of the 3 to 5 year sector of the curve, and leading the curve steeper. But we also do see a risk that if growth data continue to be resilient and we get that tail risk, a red sweep in November, I think markets will start to be focused on the risks around, potentially structurally higher deficits.
Yeah.
Do we see the tax cuts get extended? There's a lot of focus on potential tariffs and what that could mean for inflation. So in that kind of environment, I think there is a risk we could see a bear steepening of the curve where long end yields lead the way higher.
With the bear steepening, though, could that be a foregone conclusion no matter who's in the White House because of those structurally higher deficits and just more spending?
Yeah, so I think it's all right way risk, and certainly term premium and this sort of structural imbalance in the Treasury market has been top of mind for investors for quite some time now. We saw the events that unfolded last fall, and so that's not going away. There is a very large financing gap that opens up in the coming years in terms of the current coupon auction schedule that Treasury has laid out and versus how much debt needs to be issued. So there is a lot of issuance that needs to come down the pike in the coming years, and if we're in an environment where rates are still high and investors are not extending out duration, that does set up a risk that we get a bear, steeper curve.
All right, Phoebe, always great to talk to you. Phoebe White, head of U.S. inflation strategy at JPMorgan, joining us here on day one of the two-day Fed meeting. A big decision tomorrow, 2 p.m. Washington time. Of course, we will have full coverage right here on Bloomberg. The Fed Decides special kicking off at 1:30 p.m. And I was just taking a look at the trajectory of rates, Alex Steele. We talk about a 2-year yield that about a year ago was over 5%. But even at the last Fed meeting back on June 12th, or the last Fed decision, it was still camped out around 4.8. And right now, we're all the way down to about under 4.4. And with the expectation that that's probably going to go down somewhere closer into the threes.
Yeah, it's already doing the Fed's job for it, in essence, at the end of the day.
Yeah.
Companies who need the lower rates, well, you're kind of starting to get them already.
And I wonder, does the Fed, should Jay Powell just come out and thank the market? Because I feel like this is at least the second time where the market's done the work for him.
Yeah, I guess that's true. I mean, isn't that the whole point? When you have forward guidance, this is what happens. So either if you don't like it, then stop talking. I mean, is that where we're at here?
I don't know. It'll be interesting to have. I think it's going to be an interesting press conference. Who knows what the statement's going to say? But no matter what it says, he's going to get peppered with a lot of questions about when they're going to get going. All right, let's continue the conversation here as we count you down to the close. Just about 21 minutes to go. Shares of Novavax having one of its worst days in about 2 years. A downgrade, a price target cut over at JPMorgan, and a more than 20% drop in the stock. We break down what's fueling pessimism in our stock of the hour. It's coming up next, right here on The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit. Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
Time now for our stock of the hour. Novavax down more than 20%, worst day since at least February. This after JPMorgan downgraded the stock and gave it a street low price target. Bloomberg's Jess Menton joining us right now to talk a little bit more about what's ailing this company, or at least what's ailing the stock. And you just pointed this out during the commercial break. I kind of forgot.
Right.
They had a 300% rally in the span of really about 4 to 5 weeks back in May and June here. And that seems to be tied to the sell-off that we're having today. What's going on?
So Sanofi, the deal that they had back in May, so it was basically to commercialize the combination of the COVID-19 and flu vaccine together. But based on Eric Joseph over at JPMorgan, so they cut their target to $8. So that's a Wall Street low for that particular stock. If you'll get where it's trading at right now, actually around $12 roughly. But because of that big run it had from the start of the year to where it peaked out in the beginning of June, that was a 300% rise. And then since then, it's down about 40% from that point. So basically what he is arguing is the revenue that they feel like they would have gotten from that particular vaccine. They don't think it's going to be as strong as what investors were anticipating, but then also the overvaluation of that stock. Because if you compare that to the NASDAQ Biotechnology Index between almost the first half of the year, it was up about 4%, so largely outpacing its peers in that span.
Because Novavax had the COVID-19 shot, right?
That's
and then
right.
Sanofi has the flu shot. So then they would together combine,
Correct.
and the distribution would be helped by Sanofi.
Like Voltron.
Like, sure.
Oh, sorry.
Yes.
Sorry. Just ignore me.
Isn't that DC Comics? I'm more of a Marvel.
Right.
Anyway, but this actually goes to what the analyst was also talking about in terms of like what that catalyst is and
Right.
how that what the pipeline then will be for Novavax.
That's right. And so that's why they're thinking from the revenue side of things, it's just not going to be as strong of a driver for growth, even though once this deal happened, it was helpful to help kind of shore up its balance sheet and things like that when it comes to the company. But because of that and the outlook moving forward, that's why you see that as a target low on Wall Street for the stock.
And as you point out, that $8 target, I was looking at that. I mean, that's half the average price target. I mean, there aren't a whole lot of analysts covering this company, but
Correct.
still, that's a pretty bold call to say.
It is.
To go down to 8. No one's even close to him on that point. But it gets to the idea, too, I mean, kind of the Voltron of these shots, if you can indulge my analysis here. But part of the concern, I remember even when it was announced, was that what's the appetite for that, right? I mean, there are some people that are still getting COVID shots. Most people aren't. There are some people that are never going to get a flu shot. So by combining them, are you really gaining new customers, or are you just kind of It's just basically the customers you already had. You know what I mean?
I think that's the kind of conundrum that they're in right now, and that's why you initially saw that big pop in that stock. And now the question kind of moving forward, what does that mean for consumers that are either still getting separate shots or whether or not they're going to get one that is combined?
Yeah.
So is Voltron, is he a transformer?
Oh my God,
Alex,
I love the debate.
I have so much to teach you. No, it's not Transformers. Transformers is a cheap knockoff of Voltron, by the way.
Sorry.
Apologies.
Okay, but I mean, it's not. I'm a Marvel person, so this is my jam. All right, I'm glad we kind of sorted that out. Jess, thanks a lot. We release you from this now. All right, coming up, we're going to continue to count you down to the closing bells. Dana Dioria, Envestnet co-CIO, will be joining us. We'll get a check in here on where markets stand. We're trading a little heavy, yes, headed into Microsoft's earnings in just about 15 minutes time. Taking a look at an S&P that is down by about 0.5%, the Dow up 0.5%, and the Nasdaq down by 1.28%. All of those tech guys are trading a little heavy as we head into Microsoft numbers. This is The Close on Bloomberg.
AI exuberance is leading to AI impatience now, and I can certainly understand why. But you're right, for Microsoft, this is a $2 trillion company. Certainly the amount of CapEx being thrown into this is non-trivial. Right now, Microsoft has a lead in AI. This is the first tech lead Microsoft has had in a major tech shift in quite some time. Recall Azure was a fast follower alongside AWS. So Microsoft has no intentions of slowing down here as far as we can tell.
Michael Turrin over at Wells Fargo kicking us off to the close just about 50 minutes ago. A push ahead to those Microsoft earnings expected to come within the next 10 to 20 minutes.
Yeah, but either way, you have a heavy trading when it comes to tech. So you have the Russell outperforming a little bit, but that's basically because the Sprouts Pharma is doing so well, and that's a large part of the Russell 2000. But CrowdStrike, one of the worst performing stocks on the S&P, Nasdaq 100 down a full 1 percentage point off the lows. But this is not a nice tape to be going into big tech earnings for AMD and Microsoft.
Yeah, a lot of questions right now here about the sustainability of the rally, and of course, a lot of that tied to fundamentals. Dana Dioria joining us right now, co-president of Envestnet Solutions and co-CIO over there at Envestnet as well. Dana, great to have you here. A big focus right now on big tech. I guess, on one hand, we talk about this sell-off that we've seen in the NASDAQ 100. At one point today, we were almost near that 10% threshold for a correction. And I guess maybe Microsoft saves us tonight, or does it just dig that hole deeper?
Well, I think it's asymmetric because everybody wants to see good news, and I think good news would be absorbed by the market as a positive for sure, and probably prevent that correction for the time being. But negative, a suggestion that AI is not moving as fast, which is what everybody's listening for now, right? AI is just not moving as fast as maybe we hoped. We overshot. We priced too much in too fast. A suggestion along those lines, I think, has asymmetric negative for tech stocks and, for the average investor, right? Because let's face it, these big growth stocks are the market at this stage of the game. And a lot of people are, either at market, they're indexing, or they got low tracking error to the market. So it's an interesting place to be.
Even if we don't get sort of that big reveal on AI, and by reveal, I'm talking about actual revenue and profit, a growth that's directly attributable to AI, we're still talking about companies in Microsoft, the next couple of days with Meta, Amazon, Apple. We're not only just talking about 4 of the biggest stocks out there, but 4 of the biggest cash generators in the history of public markets here. So even if we don't get that AI story, would there not be enough there on the other lines of businesses to keep investors happy at these current valuations?
Yeah, I think that's it. You said it right there, right? These are cash cows. This is not the dot-com bubble. When you look at what the earnings expectations are of these companies next to their valuations, yes, they are highly priced. But at the same time, they continue to produce earnings that, justify an expectation that they can fund and self-fund their ventures into AI, and they can do it for some time. So I agree with the premise of the question completely. I think we had just gotten the fundamentals had just gotten so dispersed, right? You had at a certain certain point, 97th percentile on, your standard 60-40 valuations, given, the S&P 500 being that equity position and so much of the S&P 500 being in these stocks. And, it's actually good for the market to see the broadening out a little bit, to see small caps finally stepping forward. And of course, that's happened in a huge way, 10%, comeback in the span of a month. But for the average investor, of course, who's probably not equal weighted and maybe tilts a little bit toward that, but probably closer to market cap weighted, this looks a lot more like a pullback. And really, it's probably just a little bit of, fundamentals kind of coming into the picture a little bit more than they have been.
So let me get your take on what's happening with small caps then. So the Russell is up by about 0.5%, right? On the one hand, Lori Calvasine of RBC says, I don't know if I totally buy this one yet, because you don't get to see a sustained outperformance in small caps unless you get a recession. But then you get some earnings, and the earnings are pretty good. Just look at Sprouts Farmers.
Yeah, the thing I would say is that we do have more unprofitable companies in the small cap index than the average. The average is about 26. I think it's, something like 40%-ish now that, unprofitable small caps. So I can give you a thesis on both sides. I would say, look, we're dealing with a situation where you've got more unprofitability. You also have the situation with small caps now where and this is kind of a big, secular trend, that a lot of companies just aren't coming to IPO. They're not becoming publicly traded for longer. And so the innovation that would drive outperformance in small caps, because if you look across the history, small value in particular outperforms over time. But the thesis against that is, if a lot of the innovation is taking place when these companies are still private, then those bumps that we see in the historical data that enable that index to outperform, because it really comes from small cap companies that do well and move into mid and large cap space, maybe that's being earned by private investors and not public investors. So there is some questioning of, the thesis in general, I think. But still, at the valuations we were at, values matter eventually.
Yes, they do. And overvaluation also matters too, hence what we've seen in the tech space. Where is the asymmetric risk then, or the pain trade, over the next couple days with the Fed and with big tech earnings?
I think it's volatility. You just expect a volatile week. Obviously we'll see what Powell says tomorrow. There's an expectation in the market at this point that we're going to get a rate cut in September. You're even hearing chatter about a 50 basis point in September now. As usual, the market is probably overshooting a little bit on the good news. So I would say that with some of that, obviously small caps being more interest rate sensitive, some of that is powering what we're seeing going on, where small caps are kind of coming back in line a little bit from a valuation perspective. So, if we don't get from Powell something as dovish as the market's expecting, maybe that hurts small caps a little bit in the short run.
All right, Dana, always great to catch up with you. Dana Dioria, co-president of Envestnet Solutions. As we count you down to those closing bells, just about 3 minutes to go here. Taking a look at the Magnificent Seven, Alex, with big tech in focus here. 5 of those Magnificent Seven stocks in the red. That includes Microsoft, only down fractionally, but of course they've got a lot to show later tonight.
I'm really excited for these earnings because you have NVIDIA and Microsoft, right, two of the top most owned stocks.
Yeah.
We've already had that sell-off. So what happens if they increase CapEx? Like, what happens if they wind up not being able to deliver the kind of generative AI revenue growth?
And it's a kind of a balance, too, because if they pull back on CapEx, you think investors, I feel like would react negatively to that. You have to be in this game. And I think it's more about articulating that narrative, right? We talk so much about some of these CEOs that really just know how to spin a narrative. Obviously, Elon Musk, a master at that, even if half of what he says isn't true. But you have other, people like Jensen Huang also does a great job at this. And you wonder whether we're going to get that out of the executives at Microsoft, for that matter, Apple, Amazon, and Meta as well over the next few days.
And they still make boatloads of money. Like, to your point, if you make boatloads of money, can you spend boatloads of money? Like, they don't have the same kind of top line or margin pressure that like a Procter & Gamble does when you're sort of dealing with the consumer.
You know how investors are. They say, why don't you push that boatload of money over to us?
Yeah, that's
all right. We are moving closer to those closing bells. Full market coverage coming up right now. A breakdown of the day's events. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick and Alex Steele here to help take you through the closing bell, a global simulcast. It starts right now. Scarlett Fu joining us in the TV studio, Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our platforms. That includes our partnership with YouTube. Carol Massar, an interesting day here in the market. Green on the screen if you're in that small cap, mid cap, and cyclical space. But if you're a big tech stock, you're probably in the red.
Right. And this makes us wonder, okay, so when Microsoft reports earnings after the closing bell, is it a different story than what we got from Alphabet last week? Is the AI spend going to show in some of those numbers from Microsoft? When you've got a company that, as our BI team keeps reminding us, is trading at 35, 40 times earnings, you've got to show some kind of upside catalyst. Do we get that from Microsoft? Does it change the tone in the tech trade? We will see.
$13.27 billion. That's what analysts are projecting for CapEx spend. We saw what happened last week when Alphabet's Google missed on that number, Scarlett. So we'll see what Microsoft says in just a couple of minutes.
Yeah, and the big question is whether Satya Nadella, the CEO, will be more specific in terms of how much AI services contributes to the Azure business. He had said 7 points last time in the third quarter. Does he build on that? Does he give more concrete numbers?
And let's not forget, guys, we have a lot of other earnings coming out. We got AMD, we also have Pinterest, we also have Starbucks, and there's a lot more. And I'm really interested in Starbucks in terms of their pricing ability and the top line, right?
Is that app working again?
Yeah.
What's that?
Is the app working
Buy
again?
one, get one.
Oh, I heard. That was very upsetting earlier
Right,
today.
and of course that was tied to Microsoft as well. They're going to have to answer a lot of questions here about some of the recent outages on the internet. Let's walk you through the numbers before those earnings hit. A Dow Jones Industrial Average higher on the day, almost 200 points or 0.5% on the day. Meanwhile, the S&P doing the exact opposite, down about 29 points or roughly 0.5%. The Nasdaq lower by 1.3%, and at one point was down almost 10% from its most recent record high. Let's take a look at the Russell 2000. That's holding in the green here on the day, higher fractionally by 0.3%.
All right, real quick check on the S&P 500, guys. You have 340 names actually trending higher in today's session, 161, Scarlett, to the downside.
All right, let's take a look at the sector performances as well. 7 sectors in the green, energy and financials leading the way, each gaining at least 1%. REITs following up with a 0.8% advance, but look at the downside. It's tech. Tech is down 2.2% as a group, and consumer staples and consumer discretionary also losing ground.
All right, guys, Microsoft crossing the Bloomberg terminal. Let's get to some of those key numbers. And you've got Microsoft fourth quarter revenue. Let's go right to the top line, $64.7 billion. So that is a little bit, let's just call it pretty much smack on in terms of what the street was looking for. The estimate was $64.52 billion. Earnings per share, $2.95. And fourth quarter intelligent cloud revenue, always important to this company, $28.52. And that compares with an estimate of $28.72 billion. You've got Microsoft right now down 4% in the aftermarket.
Capital expenditures coming in slightly above estimates, about $13.87 billion to be precise. The street was looking for $13.27, so not really exceeding those expectations by a whole lot, guys. But it'll be interesting to see the market reaction specifically to that expenditure number as you see the shares now continuing to weaken in after-hours trading.
Yeah, down 7% as we speak. Satya Nadella in a statement saying our strong performance this fiscal year speaks both to our innovation and to the trust consumers continue to place in Microsoft. As a platform company, we are focused on meeting the mission-critical needs of our customers across our at-scale platforms today, while also ensuring we lead the AI era.
Yeah. Also, we should note that Azure and other cloud services revenue growth of 29%, up 30% constant currency. We knew that it was going to be around 30%, but there are a lot of analysts that were saying that it has to at least beat those numbers if it wanted to get a bump in the stock. And you're seeing right now the stock down about 7% after hours trading.
Yeah, so just to recap, I mean, you can say that the revenue and earnings beat or came in line with estimates, but CapEx moved a little bit higher already from a very high base. And as Scarlett just pointed out, the other revenue services for cloud, which includes that AI portion, came in a little bit lighter. So this is exactly what we were talking about, guys, going into the report. They keep spending more, but what they're able to deliver in terms of that profit for AI is coming in a little bit lighter than estimated.
Yeah, and this is where they're going to have to give more commentary and color, if you will, on the call to get an idea of, in terms of the investing or what the spending that is going on and how it is paying off or taking longer to pay off. I mean, this is where you need some more clarity. And this is when you've got a stock that has moved up significantly and you've got a high, PE on it. You want to see really some outperformance here. And either you're going to get it in the commentary or the outlook. That's what I think we're going to have to wait to see if on the call we get it. Because right now, investors aren't buying it. They're not liking it. And the stock is down 7%.
Okay, revenue once again coming in above estimates at $64.73 billion. Intelligent Cloud revenue coming in below estimates at $28.52 billion. The estimates for $28.72 billion. Productivity and business process revenue did come in above estimates, and more personal computing revenue also coming in above estimates. CapEx again, though, $13.87 billion. Estimates were for $13.27 billion. So that came in a little higher than analysts wanted to see.
And it's actually really being reflected here in the income statement as well as on the balance sheet. When you look at the cost of revenue here on the product side, that cost of revenue is down significantly, almost by about half. But when you look on services and other, and I put that other in quotation marks because we know what it's talking about, jumping almost about 40-something%, if my math is correct, up to about $18 billion.
You also wonder how much they're going to talk about outages in today's earnings call because of what's been happening today, but also in previous weeks with CrowdStrike's update that didn't go too well and took down every computer that seemed to have a certain version of Microsoft Office.
Well, no doubt they're definitely going to get questions on that. And just to keep in mind that we still don't know what their outlook is going to be. They're not going to give us the outlook until we get on the call. So yes, we're seeing Microsoft and other stocks like Amazon getting under pressure, but let's wait for that outlook also.
Have they actually resolved all of these issues? I mean, we talk about, I know the CrowdStrike issue is still kind of being sorted out, but then you had the outage earlier today. I know where there were some headlines saying that they had sort of resolved that, but it gets to the question here as to just how deep this runs.
It also just shows how fragile the ecosystem is. I mean, we saw basically, entire airline crippled for days as a result of this outage. And we don't
forget all the folks at Starbucks who, for some reason, could not get their coffee.
Buy one, get one free today.
Apparently, you can't buy coffee unless you have an app.
It was also like a nation, it included parts of Canada,
Which I don't
too.
understand how that works. I went into the Starbucks down the way here.
Yeah, CrowdStrike's down 40% from its highs.
Do you not want to hear my Starbucks story, Tim?
Oh, I didn't hear you say that.
Okay, Starbucks earnings are out, by the way.
Yeah, let's take a look at
I do
Starbucks.
want to hear your Starbucks story.
Comp sales down 3%. Analysts were looking for a drop of 2.7%. So not a surprise there because we know the company has been struggling a bit here, both in the U.S. and in China. In terms of U.S. comparable sales, down 2%. Analysts were looking for a drop of 2.1%. China comparable sales down 14%. Analysts were looking for a 10.6% drop. So I guess that feeds into the comp sales number overall being worse than expected. But on the bottom line, adjusted EPS of 93 cents does top the consensus estimate by a penny.
Okay, Starbucks shares up 3.5%. I'm watching shares of Electronic Arts. The company forecasts net bookings for the second quarter of 1.95 to 2.05 billion. That's higher than the estimate, which came in at 1.95 billion. The 2025 year forecast still sees net bookings 7.3 to 7.7 billion. Estimates were for 7.49 billion. The company sees operating cash flow at 2.05 to 2.25 billion. That estimate for $2.08 billion. Shares not really moving in the after hours.
Mondelez out, the big food company here. It looks like a beat all around. The bottom line numbers, EPS adjusted for the second quarter, 86 cents a share. The street was looking for 79 cents. Revenue in the quarter, $8.34 billion. That's a slight miss. The street was looking for about $8.5 billion. But we should point out that operating margins did improve, 17.9% a beat. Gross margins also up 40.5%. That's also a beat. The shares higher by about 1%.
All right, also taking a look at Pinterest here. Adjusted earnings coming in about 29 cents a share. So that was actually better than estimated. Also, the average revenue per user estimate was better than expected. However, the outlook for the third quarter, the range that Pinterest sees now is $885 million to $900 million. The estimate was for $907 million. So a little bit of a disappointment there as well.
Look at those shares.
They might get that impression growth in terms of ad pricing, but ad pricing environment is still quite challenging for the company.
All right, folks, one more we want to get to. Live Nation is crossing as we speak, and let's get to the earnings. Let me pull them up on my Bloomberg. Live Nation crossing, and you're looking at second quarter adjusted operating income, $716.2 million. That's a beat. The estimate is $660.7. Second quarter revenue, smack in line with what the street was expecting, $6.02 billion. And the company also saying the number of fee-bearing tickets, 78.47 million. That's a miss. Estimate is 81.69 million. We're seeing the stock right now unchanged in the aftermarket.
Yeah, kind of interesting, too. I mean, I was looking at the breakdown by actual events here, and they talk about concerts revenue being up. Remember, there was about 8% in the quarter, and there was all this talk about how we were going to see a drop because, of course, the big bump that you got last year because you had two mega concerts with Beyonce and Taylor Swift, and I guess now you only have Taylor Swift on tour. Is she still on tour?
She is. She's ending it in like a couple months. So.
Forever?
No, just this one time. It can't be forever. My daughter would be so sad.
Is she still dating that football guy?
Yes.
Oh.
Do we have time for your Starbucks story, Romain?
No, I think we're out of time now.
Too bad. We'll
But don't worry, I'm coming by the radio booth right after this to regale
Lock the
you.
door. Okay, Starbucks is up 3% in the aftermarket. Microsoft, they're down 7%. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. The closing bell. We will see you again, same time, same place tomorrow. And of course, we know Alex is heading out, but Scarlett and Romain are on TV, and we're going to stay right here on Bloomberg Business Week.
And we continue our coverage right here on Bloomberg Television. A focus right now on big tech, a focus on Microsoft, second biggest weighting in the S&P 500. Oscillating between gains and losses, down about 7% here in after hours trading. This as it looks a lot of concern right now about that increase in CapEx spending, despite the fact that they did beat on several key metrics in the most recent quarter. Doug Clinton joining us right now. He's a managing partner over at Deepwater Asset Management to talk about his reaction here. What jumped out at you in this earnings report, Doug?
Well, it wasn't so much the CapEx. It was really more about the cloud services number. I think that it needed to just be a little bit higher. And right now we are in an environment where you cannot miss at all. You cannot get anything wrong as a mega cap tech company. Google proved that last week, where I thought their numbers were generally fine. I thought Microsoft's numbers were, again, generally fine. But that's just not enough right now in this market, where I think investors are looking for any reason to say the AI boom is over and we want to exit tech.
I am curious, though, about when we talk about valuations. I mean, Microsoft was not necessarily one of the barn burners in the tech space. I mean, I would think it was only up about 12 or 13% year to date prior to that. And I know even at a 32 times projected earnings, there are some people say that valuation's inflated. But I'm looking at the balance sheet here. This is still a lot of cash on the balance sheet, a lot of cash generated in the most recent quarter. And of course, when you talk about the services revenue here, this is still a juggernaut here. What more do people want?
I think that they want to see more from AI sooner than is reasonable. And this has been a theme that we've been talking about at Deepwater pretty consistently. I think the reality is we've seen for the last 12 months, these mega cap tech companies have been investing heavily in building out infrastructure for a future that they see that's just not here yet. And I think that this quarter has demonstrated more than any other quarter so far in that build out that investors are getting a little bit impatient. And I think the reality is this: we're going to work through this earnings. Other big cap tech companies may have similar commentary to the others that have reported, like Google and Microsoft already, because I do think it will take time for revenue to come from AI. It may still be a year plus away. So we need to have that expectations reset that we're getting here right now.
So is that a failure on the big tech companies' part for not communicating that properly to investors? That may be another year to come. It does seem interesting that all the investors seem to have coalesced around this idea that this is a show me quarter. Now you got to really show me that all the money you plowed in to AI is going to pay off right now.
I actually think about it in two worlds, Scarlett. Like, there are investors who really pay a lot of attention to the AI story and have become experts in it. And I think that those investors have been very well versed in the reality of how long this might take. And then I think on the other hand, there are investors who they see AI as this hot theme. I think they chase some of these names. And I actually think it's that component of investors who are probably the ones that are bailing right now. They're the ones that are impatient and maybe have these unreasonable expectations. I think as we continue to think about what is the path forward from here, this is kind of the bar reset quarter, it feels like right now, given what's happening with Microsoft. And to put it in context, though, we really haven't had that bar reset relative to AI expectations since AI took off 18 months ago. So I actually think this is probably a healthy part of the process, but it might still be painful for another few reports here that we get later this week.
I think one thing that investors are looking for is just any kind of granular detail on what the AI picture looks like for revenue, specifically for Azure. In the third quarter earnings call, we know that Satya Nadella talked about AI services contributing 7 points of growth to Azure, but no real context there. What kind of number would he need to say to get investors to be on board again, to end this decline that we're seeing after hours trading and maybe push the stock higher?
It's hard to put a specific number right around, what is it about AI? Because I actually think in some ways, it's a little bit more about just the narrative that it's going to happen at this point, because we have so much promise. Because, I mean, look, 7 points of growth on a business that is tens of billions of dollars is still, right, $1 billion plus a year in annualized revenue for the quarter. And so that's a pretty big number if you put it into context. I think really what these companies need to do is help investors understand that if you want to invest in AI, you can't expect to see what NVIDIA has seen, which is immediate demand for their products driven by AI infrastructure builds. If you're investing in AI companies that are building software, that's going to take more time. It might be a year plus. I think that's the right expectation to set, a year plus, until we see meaningful movement on numbers from that AI initiative.
We should point out, Doug, I mean, a lot of the other tech companies, whether it's software companies or maybe a more hardware side company like Apple, are also in the same boat with a lot of these questions about CapEx spend on AI and when the payoff is going to be. How forgiving do you think investors will be for some of those other companies? Do you think this translates, what we're seeing with Microsoft, to what we might hear out of an Apple or even a Meta or even an Amazon?
I think we might hear it more from Meta or Amazon, a little bit less so with Apple, just because of how they've strategically positioned themselves. I think they're going to be more heavily reliant on partners for infrastructure than just their own, where Meta and Amazon, I believe, are going to be much more reliant on their own infrastructure. I don't know that CapEx is going to be the big issue. I think, again, it might come back to just seeing what AI revenues are coming out. And now that we've had two reports to kind of set the bar around AI revenue expectations and these increases in CapEx, to your point, Romain, I think that there's probably a little bit less downside risk to those two companies. So as long as they don't have any hidden issues in their quarter, it could be fine. But again, I think we're going to hear commentary, not just from Microsoft, but Amazon and Meta as well. They're going to keep investing in AI CapEx, even though the revenue's not there yet.
What do you think the potential, in your view, what do you think the potential adoption will be of whether it's AI-enabled software or whether it's AI type of hardware? And I'm looking at it more from the consumer side. I think we have a general sense of how corporations might be adopting this. But do you think the uptake on the consumer side will be there when these products really start to hit the shelves, so to speak, en masse?
I think the launch of Apple's AI product is going to be the best barometer for that. So we'll see in September and October how that phone sells. And I think the reason for that is right now AI is sort of this geeky, nerdy technology thing, right? You really have to want to go and use ChatGPT and learn how to use it well to get involved. I think Apple is so incredible at taking complex technology, making it super simple for the average consumer. And so to the extent that we see a lift in iPhone sales from this new technology that they are now incorporating in the new phone, I think that'll be the best barometer, the best indicator of, hey, is this thing ready really for mainstream consumer adoption?
All right, in conversation right now with Doug Clinton, managing partner at Deepwater Asset Management. He's sticking with us here as we break down those results out of Microsoft, but we're all also getting earnings right now out of AMD. Revenue in the most recent quarter, $5.8 billion, a slight beat over street estimates of $5.73 billion. EPS, your bottom line number, a beat by 1 cent at 69 cents a share. And here's your CapEx spend, Scarlett, which everyone, of course, wants to know about. Not quite the same AI story as an NVIDIA or even a Microsoft, $145 million in the most recent quarter, so no billion in that number. The street, though, was looking for 127 here, so a ramp up in CapEx for AMD as well. Shares up 4.5% in after-hours trade.
All right, so let's bring in Bloomberg's Ed Ludlow, who, of course, has been tracking these big tech earnings alongside us to give us a little more context here on AMD. And the numbers that we really want to pay attention to AMD, of course, is data center revenue, because that's the AI chips.
Yeah, more than doubled year on year, 115% top line growth. And I think the question is simply, is AMD taking a little bite out of the market share that NVIDIA dominates? The reality is we don't have a number in the commentary. Lisa Su talks about growth in the AI business. So come the call, like the conversation you just had with Doug, give us a number. What is the AI number? It had been due to be $4 billion this year for the MI300 family. That's basically equivalent to NVIDIA's H100. Now, NVIDIA will probably do $100 billion of H100 this year. They got some catching up to do, but the signs are positive.
You've spoken with Lisa before and some of the other executives there, and I think you might be speaking with them soon again. But I am curious as to what they've articulated already about that catch-up, because there is concern, as you know, that a lot of the people who need these advanced chips have either already bought them or they've already placed their orders for them. What's left out out there for AMD?
Well, what's left for AMD or a glimmer of hope for this current period and the call is that they were supply constrained last quarter. She basically said pretty explicitly, had we had more access to supply for our MI300s, we would have been able to give a more bullish or confident forecast for sales for the year. That's still a story, and it applies to NVIDIA as well, right? That I think you listened to Elon Musk on the Tesla call, him talking about one rationale for Tesla working on their own proprietary silicon is the anxiety about being able to get hold of NVIDIA's technology when they need it. Why? Demand is so great that it is outstripping supply at this moment in time. But we don't really know how long that will last. Even with TSMC's earnings, it's difficult to tell.
All right, Ed Ludlow, he is the co-host of Bloomberg Technology. A closer look at AMD. The shares higher by about 3% here in the after-hours trade. A modest beat on the top and bottom line, and a big interview scheduled for tomorrow. AMD CEO Lisa Su joining Bloomberg Technology, 11:15 a.m. Eastern Time. Meanwhile, we continue our coverage right here on The Close. Doug Clinton still with us, managing partner over at Deepwater Asset Management. Doug, we were talking just a little while ago about Microsoft, but I want to get your reaction to AMD and how it fits into this AI race and whether you find something attractive there at all.
You know, it's tough. It's not a stock that we own in any of our core portfolios right now. And I think what we've seen over the past couple quarters for them is, you know, we have these supply issues that you're just talking about with Ed. We have these estimates around $4 billion for the MI300. I think last quarter investors were hoping that the projections for the year, the volume on that chip would have been a little bit higher given the demand that we're seeing in the market for AI accelerators. And so it's been a little bit of a disappointment. I think that's why AMD as a stock has not performed as well as NVIDIA. They just haven't been able to deliver on the supply. And I think at the end of the day, customers are still very comfortable using NVIDIA products, even though they have a monopoly in the market.
Yeah, and even though they might have to wait as well. And to your point, AMD stock down about 13% since its last earnings, although it is higher by about 4% in after-hours trading. How does this set us up, Doug, for NVIDIA, the granddaddy of them all, when it reports earnings in late August? I realize that we have to get through Amazon, we have to get through Apple first and Meta before we get to NVIDIA, but all of these data points, you know, come together and kind of contribute to a narrative that's being formed around NVIDIA right now. What is that narrative?
I think the narrative is that CapEx continues to increase for the mega cap tech companies. They don't seem to be slowing down. And I think NVIDIA is obviously the most direct beneficiary from those aggressive ramps in CapEx spend. So I think the narrative is shaping up right now from the other mega cap tech companies that NVIDIA should continue to see strong demand for its products. We'll see how that kind of sets expectations going into the quarter. But I would say right now, it's probably a fairly decent setup for them.
All right, good stuff. Doug, really appreciate your joining us today. Doug Clinton is managing partner at Deepwater Asset Management, says for these software companies, it may take more than a year for us to really see the fruits of all that spending on AI to show up in the bottom line, in the top line and the bottom line.
Have you bought any of these AI-related products or anything?
Have
I keep
you?
getting emails. No, are you kidding me? But, you know, I mean, we have like Adobe Creative at home, you know, because my son uses it, and they always pinging us to upgrade to this AI-enabled thing. And I just don't know what the value proposition is for me yet.
Yeah.
I mean, maybe it is there, but they clearly haven't articulated it to me.
I mean, when I'm on Facebook or Instagram, it always has that AI prompt, which I ignore. If you look in the search bar on your phone, it always says like AI something, and I get away from that as soon as I can. All right, coming up, we are sticking with earnings. We're going to dive deeper into Live Nation, Mondelez, and Match. You can see them all moving in the after-hours trade. Mondelez at the moment unchanged, but Live Nation down 2.3%, Match up more than 6%. This is The Close on Bloomberg.
A ton of activity here in the post-market on the back of a wave of earnings. Let's get a roundup of some of the notable movers. Bailey Lipschultz, Jess Menton, and Emily Grafeo joining us right now. And we start with Bailey, the #1 Swiftie on Live Nation.
I am a big fan of Taylor Swift, though I did not see the Eras Tour. Unfortunately, remain a little bit out of my price range. But looking at Live Nation, down 2.8% post-market trading, it's really light volume. So not going to read too much into the direction. Looking at the results, maybe a bit mixed. We did see the number of fee-bearing tickets at 78.5 million. falling short of what Wall Street was looking for, just north of 81.5 million. But they did crush expectations on adjusted operating income in the second quarter, $716 million. Estimates were for 660. One thing that did stand out, though, looking at the CEO statement saying that they're seeing a lot of sales not only to regular fans, but also to those diehards. So, Romain, I don't know if you're going to try to catch the next Eras tour, but it does seem like people are lining up to pay up for some of those concerts. So certainly keeping an eye on all things Live Nation and what they say on the earnings call. But Jess, you're looking at snacks.
That's right. So consumer packaged good companies in particular, which we know have been underperforming pretty broadly against the S&P 500 this year, down about 16 percentage points compared to the S&P 500. But if you look at Mondelez, getting a pop here after hours, coming a little bit off of those highs, but still nonetheless, it's still up about 3%. So the big thing here was looking at organic revenue growth for its outlook. So if you look at the second quarter, it grew about 2.5% over year there. But then also, if you look at fiscal year, it actually sees organic net sales growth between 3 and 5%, actually at the high end of the range. And that's important because we do know a lot of these consumer packaged good companies, not just Mondelez, but if you think of especially General Mills, Conagra, Kraft, and others, a lot of them have a lot of that margin pain coming out of the pandemic because of volumes, but then also having to pass on those cost increases to consumers because obviously we know higher inflation. But the Fed actually over at Tom Barkin, he's the Fed over at the Richmond Fed, and he actually looks pricing power for when it comes to consumer packaged good companies. So this is something important, especially to watch ahead of the Fed decision tomorrow here. But when you're looking at this, also on the earnings call, Jen Bartashis over at Bloomberg Intelligence is looking at how, in order to pass on, especially organic sales growth, they really need to see and talk about that more on that when it comes to the call there. But Emily, what are you looking at?
I'm looking at Match Group, the popular parent company of popular dating apps Hinge and Tinder. This stock is popping despite the fact that the company missed its revenue forecast, but it was overall a mixed bag of earnings. The number of users that actually pay for Tinder dropped 8% year over year to 9.6 million. That was better, slightly better than estimates, but marks the 7th straight quarter of declines for those Tinder users. And these earnings coming a few weeks after Bloomberg reported that Starboard Value had built a position in the company, an activist stake of about 6.6% in Match, the third activist investor this year to take a position in Match. So watching what they're looking at for these earnings reports.
All right. Thank you so much, Bloomberg's Emily Gorfeo, Jess Menton, and Bailey Lipschultz. Really appreciate the wrap-up of all the different earnings. You know, when it comes to Match, what was interesting, I read a story about how, you know, there's a generational shift in how young people find dates, and it may not necessarily be on these apps.
Yeah,
I don't know.
I've heard they're going old school, like just going back to like restaurants, bars, gyms, grocery stores.
I mean,
the
they don't make phone calls,
way.
so I don't know about that.
I don't know. I don't know.
They slide into each other's DMs.
Let's
That's
just
what they
say
do.
I'm glad I'm married and I don't have to deal with this mess. All right, coming up, we're going to dig into Starbucks. That's coming up next.
This is Bloomberg Markets, The Close, and we're looking at shares of Microsoft right now, down in after-hours trading by 6%. And this comes even as the company has talked about how AI has contributed 8 points to its Azure revenue growth versus 7 points the previous quarter. So let's bring in Anurag Rana of Bloomberg Intelligence to join us now. So these numbers, these are hard numbers here that Satya Nadella, the CEO of Microsoft, is now offering investors. How do you read that 8 points of growth contribution from AI?
No, that's very good. I mean, if you look at it last quarter, this was 7 percentage points. If you extrapolate it, now the company does not disclose Azure numbers in dollar terms, but when we do some math, we look at this at somewhere a little over $1.3 billion of contribution from AI sources, which if we annualized it, roughly around 1.4 billion. So if you annualized it, it's over $5 billion or so per year. So very good contribution. I think this is more a function of higher expectations from investors rather than anything else. Microsoft actually performed very well, both on total sales growth as well as Azure growth rates.
When you look at the growth rates, or more importantly, I guess, the contribution of AI to those growth rates, Anurag, are there other companies, other peers out there that are seeing similar numbers?
Oh, no, nobody is able to disclose these on the software side at this point, only because Microsoft has an advantage because of OpenAI. It has a partnership with OpenAI. It provides cloud computing services to that. So when you see more user engagement on OpenAI, whether it's on the enterprise side or the consumer side, Microsoft makes more money.
So, of course, we have Amazon and Apple reporting later this week, along with Meta as well. And all of them are trading lower in the after-hours trade as Microsoft declines about 6% right now. Does this reset any expectations for those companies?
I think if you really look at it, this is more of, I would say, investor sentiment side psychology away from big tech companies, which probably started 2-3 weeks ago when we saw rotation come in. But if you really look at it on a fundamental basis, the growth prospects of none of these companies have deteriorated, over the last 6 months. In fact, I would say when you look at something like an AI, it is pivoted towards larger companies having an advantage over the smaller ones.
All right, Anurag, going to have to leave it there. Anurag Rana over at Bloomberg Intelligence, a closer look at those earnings that we got out of Microsoft. We turn now to the earnings that we just got out of Starbucks. Those shares are higher in after-hours trading, despite a miss on same-store sales, as diners pull back spending on coffee and other treats. Wedbush analyst Nick Setyan joining us right now. He's got a neutral rating on the stock. Let's go through the numbers here, and let's start here in North America. The numbers weren't great here, but I'm not quite sure what investors were looking for. What type of growth, Nick, were you looking for? What type of growth do you think they can achieve?
The -2 comp, in North America, U.S. was actually good enough, and importantly, the 16.7% EBIT margin was better than 16.5% expectation. And I'd say the buy side was even lower than that. So 16.5 was consensus, buy side was even lower than that. So that was good enough. We don't get any guidance commentary in the press release, so we have to wait for that on the call. But essentially, decent FQ3. It wasn't a disaster like last quarter. Hopefully that de-risks the near term in terms of FQ4, and then we'll try to basically focus on what they're going to say around any early signs of what FY25 might look like.
Yeah, we're now looking at 2 straight quarters where we've seen at least top line revenue growth contract. There's a lot of questions here about the international side of this business, particularly when it comes to China, which is still probably the biggest laggard in that company's portfolio. When does that stop mattering?
Frankly, I think it's more or less already stopped mattering. I mean, it's less than 10% of their operating margin. Is probably closer to half that now. It'll be great when it turns around, but at this point, in terms of just profitability contribution, margin driver, et cetera, I don't think investors are paying too much attention to China any longer. I think the key is still just simply the U.S.
Okay. We know the company is under a lot of pressure. The activist investor Elliott Management has built a stake in Starbucks. We don't know the size of it right now. Of course, it's pushing Starbucks to boost its stock price, but do you see changes on the horizon, meaningful changes like a CEO change at Starbucks?
Frankly, I'm not really sure what anybody can do at this point, right? I mean, Schultz was there. This guy is his handpicked, successor. He just started in September, so it hasn't even been a year yet. And again, it was handpicked by Schultz himself. So, I'm not really sure, what exactly they can do that's different, aside from, essentially just having to wait it out until grocery inflation catches up or at-home inflation catches up with away-from-home inflation. That's going to happen, basically in the first half of calendar 25. I think that's going to help everybody, including Starbucks, McDonald's, et cetera. So I just think it's a tough period for everybody, including Starbucks. And it's just going to be very difficult operations-wise, in my opinion, to change anything.
So, I mean, it sounds like the macro environment is so all-pervasive that there's not much Starbucks can do to adjust that. We know that it's been launching new beverages. We know that it's got these aggressive promotions. Does that, deteriorate the relationship with the customer or train the customer in a certain way, the consumer, to expect constant discounting in a way that might hurt it later on when the broader macro environment does kind of get better for Starbucks?
I'm not sure if it trains the customer to expect discounts. I do think that maybe we've gone away from that sort of in-person touch towards more order ahead and pick up. You walk in, you don't say hi to the barista, then you leave, right? So that was a big part of the Starbucks culture. Everybody used to know your name, et cetera. So there are some things that have changed, but ultimately, the current results, in my opinion, is more of a function of just the success they had over the last 3 years. During the COVID years, there was a lot of aspirational spending in terms of income groups that moved up to paying $6, $7, $8 for a cup of coffee. Now we're just seeing a little bit of a normalization.
Well, Nick, it's interesting you bring up those last few years, too, because we should point out that since then they've gotten a new CEO. I think he's been on the job a little more than a year now. And there's been a lot of concern here about his strategy. What was it called? Like the triple pump shot or whatever he called it. You had Howard Schultz on a podcast criticizing him. You got Elliott Management circling the wagons right now, trying to pull something else out of them. And you got employees, at least the ones who want to unionize, that also seem to be unhappy with this strategy here. I mean, how do you rate his performance so far, I guess, 14, 15 months into his tenure?
I give it a C. So, I don't think it's worse. I don't think it's any better. But essentially, Howard Schultz had already put in a road plan for the next 2-3 years, right? I mean, it's not like anybody else was going to follow a different path. So I'm not sure, how much it really helps for Schultz to blame the new CEO, when in fact, Starbucks has basically been on autopilot, ever since he implemented a lot of the operating initiatives, the speed of service initiatives, the tech focus, the pay ahead, pickup, et cetera. So a lot of the things that Starbucks is undergoing right now, those are all essentially Schultz's blueprint. So I'm not really sure, to what extent you could put it on someone else's feet.
Yeah.
All right, well said. Nick Sechan over at Wedbush giving us his take on Starbucks results. We do have some breaking news here, and it has to do with U.S. politics. In the latest election poll, a Bloomberg Morning Consult survey, Kamala Harris has wiped out Donald Trump's swing state lead. The survey measures Harris-Trump contests in 7 battleground states. And according to the poll, black and young voters are more enthused since the departure of Joe Biden, the president, from the presidential race in November. So once again, Kamala Harris and Donald Trump are tied in this new Bloomberg Morning Consult survey.
Yeah, kind of interesting here. I mean, the main swing states that they're looking at, of course, names like Arizona, Nevada, Pennsylvania, Wisconsin here. Interesting to look at the numbers here. Again, you can read that on the Bloomberg terminal, Crossing the Wire right now for a fuller analysis here of that Bloomberg Morning Consult poll.
All right. And of course, we are keeping an eye on all the earnings here. Let's take a look once again at how some of the stocks are trading. Or no, this is how they closed on the day. Pardon me. And this, of course, is what in the lead up to the results that came out after the bell. It's pretty clear. Straight red line down.
Yeah, and it's kind of interesting, too, because we talk about sort of what investors want, and that seems to be kind of the theme that we've talked about, whether you're talking about AMD or Microsoft or Starbucks, the idea that some of these stocks, at least, not necessarily Starbucks, had these run-ups. There are high expectations, and the question is, when do you really see the fundamental fruits of all that spending?
Although, to be fair, for someone like Microsoft, a company like Microsoft, the results, as many have told us, are not terrible. They're, in fact, pretty decent, but it's just that investors want more, given the run-up.
I looked it up. Triple shot reinvention with 2 pumps. That was Laxman Narasimhan's strategy that he named it, which doesn't quite roll off the tongue there.
No, I don't.
Triple shot reinvention with 2 pumps.
How do you go into the store and ask for that quickly?
I don't understand. A triple shot, but with 2 pumps.
Yeah.
I'm confused.
All right. This is the close on Bloomberg.
We're on Central Bank Watch. Markets fully pricing in a September rate cut for the FOMC after some encouraging signs from recent inflation data. Here to talk about maybe what we might learn out of the Fed tomorrow as it makes that big decision is Raghuram Rajan, professor of finance at the University of Chicago Booth School of Business and, of course, former governor of the Reserve Bank of India, as well as a former chief economist over at the International Monetary Fund. All right, Raja, there's been a lot of talk right now about the idea that the Fed and all the data points that we've gotten leading up to this meeting basically leaves it with no choice other than to at least telegraph some type of cut sometime in 2024. When you look at the data that we've gotten so far, do you think that would be justified?
Yeah, I mean, as far as the Fed goes, I think all the recent data point towards, things moving in the direction it wants. It's not there yet, but it's moving in the right direction. Certainly, Chairman Powell doesn't want to commit himself in his post-decision talk to a cut in September, but he wants to hint as much as he can. I think the Fed is seeing, well, inflation is near abouts where it wants to be. 2.5% on the core PCE is getting there. And labor markets are certainly cooling, at least when you look at unemployment claims. Openings are down to 1.2 per unemployed person, and quits are low and stable at below pre-pandemic levels. So other than the jobs numbers, which are still in the 100 to 200 range, it is a labor market that seems to be cooling off. And of course, there are other parts of the economy which are showing signs of some stress. I mean, housing isn't great.
Yeah.
And of course, you look at credit card defaults and all that, it's starting to pick up. So the Fed is saying we're nearly there. If we wait too long, we see a slowdown, which we don't want.
Well, that's what I'm curious about, particularly when it comes to the consumer side of the equation, household spending, and the idea that we have started to see softness there, at least softness that showed up in the official data. And of course, there's a ton of anecdotal evidence out there that households have at least started to rethink just how much they spend on discretionary items. How much does that particular data point have to factor into this decision?
It does weigh into the Fed's decision. But remember that at the aggregate level, at the overall level, the economy is still chugging on pretty strongly. The second quarter growth numbers were really quite strong at 2.8. And what you're seeing is, for every sort of bit of weakness that you hear about, there is potentially an offsetting strength. What the Fed doesn't want to do is maybe, cut in July and then see things pick up. There's also the sort of uncertainty surrounding the election. How much do they want to ease before the election, only to see an administration come in which may change things on the ground substantially? So I think a gentle cut, if the data cooperate by September, is what they want to sort of signal. And I think it'll be hint, nudge, without any kind of commitment tomorrow that they will indeed cut in September.
To give themselves maximum optionality, as they've been careful to do each step along the way. So Raghuram, you had mentioned that the labor market seems to be cooling, but I look at the estimates for job growth for the jobs report we're going to get on Friday, and an estimated 175,000 jobs added after 206,000 jobs were added in the month of June. You don't really see signs of cooling as much in new jobs growth as you do in, say, jobless claims or job openings and quits. Does that matter, that mix?
That's right. I mean, it's not telling the same story. But then, household surveys, for example, are telling a different story from the payrolls. So I think, again, there are lots of data out there. Depending on your persuasion, you can find something to satisfy you that cuts are way overdue, or, we should wait a little longer. I think the Fed is going to be fairly pragmatic and say, well, we don't have an economy that's tanking yet. And if it does show signs of weakness, we can always cut a little faster. So for now, let's hold and see what happens, and we can cut in September.
Do you believe, Raghuram, that we're going to get a unanimous decision? And I ask that because Bill Dudley, of course, the former New York Fed president, wrote an opinion piece for us where he said he has changed his mind and now sees the need to cut this month as opposed to waiting until September because that increases the risk of a recession. Will anyone stick their head out on that idea when it comes time to vote tomorrow?
It's not an entirely bad outcome if one or two depart from the overall decision, especially towards a cut. It shows that the Fed is debating things. And in this environment where the political pressure on the Fed will start amping up before the election, it's good to show that the Fed is mildly split. But, let's see. I don't know if they will engineer that, or it'll come because of natural differences in opinion. But I don't think it's the end of the world if there is a little bit of a split.
Right. I have to ask you a little bit about what's going on overseas, because there's been a lot of talk about the idea that we might start to see significant divergence in central banks. We know the ECB has already cut. There's a big question as to whether they'll do anything else again and whether they went too early. But I'm wondering if it actually matters this time. I know we used to, in the past, focus so much on the correlations between these central banks raising and cutting, at least somewhat in sync here. But is that sort of the wrong thing to look at this cycle?
No, I think it does matter. You can see the problem with Japan, right? When Japan was, holding firm on relatively mild monetary policy while everybody else was tightening, you saw a weakening of the yen, and that has had an impact domestically, both in terms of consumer confidence as well as inflation. Now it would seem this week, tomorrow, Japan has to make a decision, and it will probably start raising rates, even as the rest of the world is starting to contemplate cuts. There does have to be an equilibrium, and if it doesn't sort of emerge, you see the effects in exchange rates, which eventually cause central banks to have to adjust. I think the ECB is seeing weakness in Europe right now, so they actually have a greater reason to cut in September than potentially the Fed has at this point.
Well, it's interesting you bring up Japan, because obviously they're going in a different direction than everyone else, and maybe that's a good thing. I am curious. I mean, you've seen a lot, of course, going back to your days at the IMF and then, of course, at the Reserve Bank of India. When you look at Japan and this multi-decade doldrums, if you will, that it's been in, do you look at what's happening now as sort of a real upcycle, the idea that they're finally breaking free from the past and moving on to something better?
I think they are, and it's not just monetary policy, of course. There's a lot of work on corporate governance. There is now a greater sense, for example, that Japanese corporations have to deliver a value for money to their investors, and there's been a lot of pressure on them to up their game. So I think Japan has spent a lot of time in the doldrums, but is slowly starting to come out for a variety of reasons. This time is different. But of course, Japan still has the huge aging problem that, other countries are yet to confront, but will eventually. And how they manage that is going to be really important. How much immigration do they allow? How much immigration can they sustain? So it still has problems, but I think at least the malaise from the Great Recession and the slowdown after that is finally coming to an end.
All right, Raghuram, we started with the Fed, so I want to end with the Fed. What is the headline going to be tomorrow when Jay Powell speaks? Where could he surprise everyone?
I think he's going to try not to surprise anyone. He's going to try and say, look, we're still in data contingent mode, but the data are cooperating right now. And, if things go the right way, you guys should expect some good news in September as far as rate cuts go. That's sort of the message. I don't know how clear he's going to be, but that's the message he's probably going to send.
All right, we got to leave it there here. And always great to talk to you, and great to see that view. I'm not sure exactly what way your window's facing, but if you turn to the left or the right, you actually see the home that I grew up in, right down the street there.
That's the University of Chicago, right?
I know, right down by Medici. I don't know if it's still there. Raghuram Rajan, always a pleasure. Professor of Finance at the University of Chicago, Booth School of Business, former Reserve Bank of India governor. We're going to set you up for some of the other big events to watch tomorrow, so stick with us. This is Bloomberg. All right, let's look ahead to what the markets will have their eye on over the next 24 hours, and we start overseas. A big decision by the Bank of Japan.
And the Bank of Japan may very well raise interest rates, but what I found curious, and we were just discussing this, is we don't know exactly what time this decision is going to come out.
Yeah, they kind of keep this, it's usually kind of around the same time, but they kind of keep this in the dark. It's not like the Fed where you can just kind of set your watch at 2 p.m.
That's so interesting. Why not tell everyone?
Because it's Japan, Scarlet Fu. I have no idea. I feel like they do everything different over there for one reason or another. Meanwhile, back here in the U.S., we get more earnings and some big ones.
Yeah, well, Boeing's going to report, Kraft Heinz is going to report, KKR, MasterCard. So as a whole, sampling of the broader economy. And then after the market close, more Magnificent Seven names.
Yeah, Meta is actually going to be a big one, obviously, because of their whole push into AI and the metaverse. Qualcomm could be interesting as well. And what about the rebound that we've seen at Carvana?
Yeah, in fact, we're speaking with someone from Carvana.
Yeah, this is like a huge rebound story because this was a stock that a lot of people left for dead just a couple of years ago. Meanwhile, we also get that big Fed decision, 2 p.m., Scarlett, if my watch is telling me right.
You can set your watch to that. Yeah, and 2:30 p.m., Jay Powell comes out and tells us that, they're thinking about all their different options.
And we also get a lot of economic data as well. ADP numbers at 8:15, the employment cost index over at 8:30. We got a Treasury refunding and pending home sales as well.
A lot to sift through.
All right, that does it for us. Join us tomorrow. This is The Close.